I'm Greg Hunter. Welcome to USAWatchdog.com. With us a regular guest. He's a former Assistant Treasury Secretary. He is the father of Reaganomics, trickle-down economics. He's a PhD in economics. Also, he's a top journalist, global award-winning journalist. Used to be a top editor at the Wall Street Journal, but that's little stuff. He's gone worldwide now. I'm talking about Paul Craig Roberts, Dr. Paul Craig Roberts. Thank you for joining us today on USAWatchdog.com.
It's a pleasure.
Listen, I just want to talk to you about this crazy thing about the IMF and the crazy markets, because I know you know all about it. You're a PhD in economics and you're a former Assistant Treasury Secretary in the Reagan administration. The IMF came out with the most bizarre warning about profits for big banks like Citi and, of course, Barclays and Deutsche Bank, which it named the most systemically dangerous bank in the world at one time. It looks like they added them to a list and then said the regulators need to be watching these banks. These 9 banks, there's some in France, there's some in Eastern Europe, Unicredit, there's some in Japan, 2 or 3 in Japan, UK, Citi, of course, the US, but there's 9 globally systemically problematic banks. This is according to the IMF. What do you make of this warning now that the banks, that they're telling regulators to watch these banks and they're systemically important? In other words, do we have 9 Lehman Brothers?
Greg, you say I know all about it, but of course no one does. And why? And the reason is when they repealed Glass-Steagall, they removed the ability, they created the ability for these new mega banks to gamble. And that's what they do now. They don't lend to industry, to manufacturers. The kind of ways they used to make money are gone, and they basically are gambling, and they are creating all kinds of derivative instruments, the consequences of which I don't think are well understood. And as for the stocks, the equity markets, they're all highly inflated by the policies of these central banks in creating so much money. It's not just the United States that was doing quantitative easing. It's currently Japan, the European Central Bank, the Bank of England. So you see all the 4 large components of world money, the Japanese yen, the euro, the British pound, the US dollar, they've all been created in enormous quantities. And in order to do that, or the way they've done that, is these central banks print money and buy up financial assets, bonds, but also stocks. The Japanese central bank actually purchases equity shares as well. I believe that the Federal Reserve does that. Anytime the market starts to break, I think they run in and purchase S&P futures to stop the market from falling. So they all now have these massive trading desks. They can intervene in any market, not just bonds. And so you have these very low interest rates because they've purchased all of these debt instruments. So the interest rates are so low, the banks do all kinds of arbitrage based on the fact they can borrow money at essentially 0 interest rates. And so you have this whole accumulation of financial values based on money creation. So trying to examine the equity market in any sort of traditional way, you can't do it. It doesn't make any sense. They're very high PE ratios, and we have also many corporations borrow money, which they can borrow at such low rates, to buy their own stock. And so that pushes up the stock, and therefore the executives and the boards can cash in on their stock options And so it's all sort of a short-term thing, making lots of money in the short term at the expense of essentially destroying the companies. You know, it makes no sense for a company to incur debt to buy back its own stock. And it doesn't make any sense to create money for a decade and inflate all the financial markets. Because the reason the Dow Jones is so high is because of all the money that's been created. So that doesn't allow you to have a very good idea of what's going on. It's all been done deliberately in order to save a few big banks.
So what they're worrying about, they're worrying about them. That's why they're worrying about profit, because they don't make profit the traditional way. They're worried about somebody making a bad bet and taking the whole system down. That's what it sounds like you're telling me.
But they've probably already made all these bad bets. They do arbitrage on everything. You know, they're derivatives on currencies, derivatives on essentially everything. Student loans, car loans, truck loans. I mean, it's endless. And because when the banks busted a decade ago, you remember when we had the financial bust, they didn't punish the banks. They didn't correct the mistake of repealing Glass-Steagall, because Dodd-Frank or Frank Dodd, whatever, it didn't do much. It doesn't really. What it tries to do is to substitute higher capital requirements such that the banks have more reserves to fall back on to cover their own bad bets. But I think the derivative bets are far beyond the ability of a bank's capital reserves to cover. And of course, the banks, they like this leverage. That's where their money is coming from. I don't know how long it's been since the large banks actually did banking instead of gambling. So it's a very dicey situation, and so I think it was correct to call attention to it.
And they must be worried. Another friend of mine said, you know, you got another interview guest. A lot of my guests turn into friends. But anyway, one of my guests said that the big question is, why is the Fed? I think it was Chris Martinson. Why are they so worried, terrified by a 1 or 2% correction? They're terrified. They can't let it happen. They don't let it happen. To your point, they buy the futures market. They do all kinds of manipulations. What do you suppose? Are they terrified of any kind of correction, that the whole thing will come down?
I think so. Yes, because it's not based on reality. It's based on massive liquidity, and so it's full of all kinds of dangers. Yeah, what happens if there's a correction, then some of these derivatives come unwound? You know, think back to the crash in, when was it, 07, 08?
Yeah.
No one had any understanding of the vulnerability. You might remember there was a book written and a movie made, and there were really only 3 guys who were outside the system who could see that the whole thing was phony. And
the Big Short.
The
Big Short, I think.
On what they knew was going to be a coming collapse.
The Big Short, I think you're talking about.
The Big Short, yeah. I mean, this is
Dr. Michael Burry.
Yeah. Well, the entirety of the financial system, except for, this tiny handful of people who were not actually participants in it, had a hard time even finding a way to take advantage of their knowledge that it was unstable. No one knew. That they had no idea this was coming. And if you just look at AIG, they had one guy doing one thing, another guy doing the other, and the combination of it, no one understood, was totally destructive for AIG. And so I think it's still that way. I don't think anything has changed. The bailout did not cause the banks to change their behavior. And Frank Dodd simply said, you got to have more capital. But, you know, you can't, a bank can't, look, what was the size of the bailout? I've heard things like $14 trillion. Well, there's no way the banks are going to have capital reserves of 14 trillion. So it's very dicey. I mean, the only reason people are in the stock market is they see the liquidity is flowing. And the minute the liquidity ceases, that is, if the Fed actually were to stop providing money, and the European Central Bank and the Japanese Central Bank and the Bank of England, and you didn't have all this money coming out, the equity values would collapse. So it's just a very, very dicey situation, and the Fed and the other central banks have let it go on for a decade. And the legislators haven't done anything about restoring Glass-Steagall, which separates commercial from investment banking. There's no separation anymore, and investment banking today essentially is gambling. So, yeah, I think the situation is probably worse than they said.
You think it's more than 9 banks?
They gave their real concerns, they'd be afraid to do that because of some impact it might have. So I don't think it's understood. I don't think people understand what the situation is, but it does seem to be dependent on a continual provision of central bank liquidity.
Hugh Hendry, with a rising, rocketing market, he's famous. I don't know if you know who he is. I'm sure you do. He's, I think, in the UK, famous, renowned hedge fund manager. Folded his hedge fund, gave everybody their money back, and said, his quote was, "It's not supposed to be this way." In other words, my read was he just can't. He read a long dissertation as why he's quitting, and basically it's because he can't invest. He can't read the markets. It's not supposed to be this way. Is what one of his quotes was, and. Now I'm seeing more and more all-time record high now to the bubbleheads on the TV. They're like, ooh, all-time record high stock market. But the money managers are starting to get shaky, weird, like they're not all happy that they're getting this record high. What do you suppose the reason that is? That some money managers are getting awful nervous about one record high in the stock market after another. Just give us your opinion.
Well, I think it's what the hedge fund guy said who quit, which is what I say. Nobody understands the situation. And so many of the profits are phony. They're dependent on the cheap money, the cheap interest rates, the availability of liquidity. They are dependent on firms using their profits or going into debt to buy back their own shares. That keeps the market up. Where do the company's profits come from? Basically from laying off people, from jobs offshoring. If you dismiss your American workforce and send the work to China or India, your labor costs drop, your profits go up. But these are not profits from an expanding market. These are not profits from rising consumer incomes, from the workforce your own workforce doing well. And so they're profits that are created by destroying the domestic power of consumers. They simply lose their manufacturing jobs, they lose their IT jobs, their software engineering jobs, and they have to find some other kind of work which is paid less, so the U.S. market isn't there, and so the profits for the firms aren't coming from the growth of the domestic American market. It's come from cutting labor costs by moving wages offshore. Well, this can work in the short run for the firms, but in the long run, it destroys their ability to be profitable. The domestic U.S. market, retail sales are not growing. They're not booming. The jobs that are available and are reported at the monthly job reports are, for the most part, lowly paid domestic service type work, increasingly part-time. So how then can you have a stock market, record after record, when the domestic consumer power of the population isn't growing? You can't. So, yeah, people look and say, what is this? How can this be? Now, money managers are really just competing against their peers. So as long as they're all doing the same thing, and they have a good standing relative to their peers, they are successful. So they all stay in the game.
Yeah, speaking of stocks, you're not invested in the stock. You can't be invested in the stock market after what you just said. You are not invested in the stock market, I take it. I mean, am I wrong?
Can't be invested in the bond market either.
So what would you tell people to do? I mean, I know gold and silver have been, actually gold's got a little pop, and so is silver. Would you just hold your trade and buy gold and silver, knowing at some point, and I don't know, I'm not going to even ask you on when, but you know it's terrible, knowing at some point this thing's going to zig when everybody zags and it's going to come crashing down? Or would you just hold a gold and silver physical metal trade?
No one knows what to do. Look, if this hedge fund manager doesn't know what to do.
That's right, Hugh Henry.
Yeah, he doesn't know what to do. No one knows what to do. And so what most money managers are doing is watching the Fed very closely. And as long as the Fed is not going to curtail the growth of liquidity, they're staying in the market because it's going to rise. So this is why there's so much attention. Oh my gosh, is the Fed going to raise the interest rates? Now, of course, if they do raise it, it's such a small amount that it's not really an increase. I think, Greg, that they've only raised the rates 75 basis points over all these years.
Yeah.
That's 3/4 of 1%. Well, during all these years, the inflation has been far higher than that. So they haven't raised interest rates in real terms. Actually, the real interest rate is falling.
Wow.
Because even with their low measures of inflation, it's higher than 75 basis points since the Fed started its interest rate increase policy a few years ago. So there's been no rise in real interest rates. And in fact, we have negative interest rates in real terms. And the Fed's afraid to do anything about it. And I think it's because the minute you don't have the liquidity to pour into the market, it's untenable. It's at a level that cannot be justified on a real basis. As I said, the sources of profits largely are moving labor costs offshore. And the high stock price is due to firms buying their own stock back and to the introduction of a constant stream of liquidity by the central banks. They're not due to strong consumer demand, rising retail sales, rising real incomes of the workforce. Those are the normal things that drove stock profits. They're not there to drive it. And so it's artificial. But if you're a money manager and you say, well, I'm not going to be in the stock market because it's dangerous, and you pull out, but the stock market keeps rising for the reasons we've discussed, then you lose all your customers. They all move to somebody else. So all these money managers are in the market, and that's where they'll stay. Now, it's very difficult to be in the market if you know anything as an individual, but it's a mistake not to have been in it this last decade because it's gone up dramatically. And there's huge paper profits in the capital gains. So it's one of those situations where you have to know you're at extreme risk, but as long as the policy continues, it's going to continue to be profitable for you. So I think that's really what's going on, and I agree that how does the Fed unwind this? You know, and it's so bad in Japan, for example, that they don't hide the fact that they also buy the central bank, the Japanese central bank, also purchases stocks, equities. So you're not supposed to have a central bank buying your stock market. It's clearly propped up. The whole thing is propped up. So you have everything propped up. What are the consequences for ordinary people? Well, retirees who expected to have interest income to supplement their Social Security. A retiree doesn't really want to be in the stock market because if you have a big adjustment, you can never recover. You may not live long enough to recover. So you've got all these people with no return on their life savings. You get nothing from CDs or bonds. So they're having to draw down their capital and live on their capital rather than the earnings on their savings. So this is disastrous because it eats up accumulated private wealth, and there's nothing for heirs. So, it's a really serious situation for the general economy, and I think it shows that the Federal Reserve, in fact, apparently any of these central banks, are really only there for a handful of big banks. That's all they're concerned with. All the Federal Reserve has been concerned with for the last, how long? Decade, easy, if not more, is the welfare of a handful of mega banks. And of course, the banks are too large. They should never have been allowed to get that large. When you have a bank too big to fail, then your policy has failed. You've allowed too much concentration. Where's antitrust? Where's the Sherman Act? Everything that was legislated in the past to prevent the kind of looming catastrophe that's hanging over our heads, as the IMF said, or was it the Bank of International Settlements or the IMF?
The Bank of IMF.
IMF. You see, this is a looming catastrophe. It's produced by the central banks. Oh. And they are perpetuating it because they don't know how to get out of it. They don't want to bring on the collapse. And yet there's nothing in the real economy to support these asset values. It's particularly true also of the bond prices. I mean, why do you have zero real interest rates when you have an enormous expansion of debt? The debt expansion is enormous. And there's no reflection of the risk of this debt in the interest rate. So the whole thing is just, it's an absurdity. But it will pay in equities as long as the money keeps coming out of the central banks.
Last question. Could something like action in North Korea just pop this whole bubble? Could it all come tumbling down if we have, they shoot at us or we shoot at them or whatever? Just, for example, North Korea. Could that be the thing, that the black swan, the gray swan, I don't know what we would call it, that could take down this house of cards? That's what you've called it in the past, a house of cards.
Well, there's no direct relation between that and and the central bank's putting out money. But if everybody is already completely nervous and, just sitting on pins and needles, anything could cause them to flee. But there's no real reason for any war conflict to cause the central bank to change its policy. Look, we've been beating up countries now for, since Clinton attacked Serbia. We've destroyed and hold apart in the last 17 years 7 or 8 countries in the Middle East. Those wars didn't cause any reduction in central bank liquidity. We're on the verge of trying to push ourselves into war with Russia. If anything should blow the market would be the prospect of nuclear Armageddon. But nothing has happened. We threaten. We don't just threaten North Korea. We threaten China. We threaten Russia. Anybody with the slightest intelligence can see that the United States is surrounding Russia with military bases, creating an environment among the population for war with all of the anti-Russian propaganda, all the false accusations and Russia-gate and all the rest. And most people understand that all this Korean thing is about is it gives Washington the opportunity to put nuclear missiles on China's border. And the Chinese know that. So all of these are highly dangerous things, and they haven't shaken the market. So I don't think anything, first of all, I don't think anything is going to happen in Korea.
Good.
The Chinese made it clear they simply will not tolerate it. The Russians have too. So, unless the people in Washington are doubly insane, what this is really about is Trump trying to get the military security complex off his case. They got on his case because he was going to normalize relations with Russia. Well, that was a threat to the budget and power of the military security complex. They've got to have an enemy. And so they started in on Trump, and he saw they were stronger than he is, and so he's turned into, an aggressive war supporter. So he's talking tough about North Korea, and of course, Washington uses that to put missiles. They can tell China, oh, this is not directed toward you, it's directed toward North Korea. Just as we created the Iranian crisis so that we could tell Russia the missiles we're putting on their border has to do with Iran, not Russia. So it's mainly that, in my opinion, that's going on in Korea. I don't think that the Koreans will attack first. And China and Russia said that they will prevent any attack on Korea unless Korea strikes first. Then they're washing their hands up. So I don't think there's any chance of that being a war. It's mainly Trump showing how tough he is and getting the military security complex off his case because he's worried they're going to try to frame him up, have Mueller. We've still got this study going, whether or not Russiagate is real. We have this independent counsel, the former FBI guy. So on the whole, it's just not realistic that there's going to be any war there. But again, as we said, so what if there is? The question is, does the central bank stop the liquidity? There's no reason because of a war. You know, we've
But
talked
obviously,
so many times. Let me say one last thing.
Okay, all right.
It seems to me that the only thing that would cause the Federal Reserve to stop the liquidity would be if the U.S. dollar fell under attack. If for some reason people decided, hey, we don't want the dollar anymore, and they started moving out of dollars into other currencies or into something else, it just ceased to hold assets in dollars. If that happened, the Fed would have to try to raise interest rates to support the dollar.
Wow.
And
so watch the dollar.
So then you could see, well, everything could come apart. If the interest rates go up, there's probably all kinds of derivatives that would not be, sustainable. The stock market would collapse. It would be a mess. It would be an utter mess. And that's what the IMF is worried about. It's a mess situation. How do you get out of it? And I think it's nonsense to pretend you can get out of it by building up the capital reserves of the banks. There's no way. So it looks to me like it's a situation they got to keep going. They're going to keep it going as long as they can.
And wow, that was enlightening. So just watch the. I mean, you boiled it down to something simple because you're very smart, and don't tell me you're not. You are. Watch the dollar. Just write down to watch the dollar. If the dollar cracks, then that's the end of it, right there, right?
I think.
Okay, and how would the normal person watching this? Because now people are sitting there watching this, going, "What do I do? What do I do? What if you would just tell somebody just the simple terms? Own your car, own your house, own some real stuff that they can't take back from you. I mean, how does the common person protect themselves?
Well, I don't think I would not be in debt, but Americans are, because how they maintain their living standard is to use their credit card. And you've got now, at least according to reports, of course, you never know about reports anymore because the media is so unreliable.
Yep.
Any kind of information that's trustworthy is hard to come by. But we now have reports that there are millions of Americans who can only pay the minimum payment on their credit card. Well, that means their debt is rising, even if they don't, buy anything. Because if you only pay the minimum payment, the interest, that's not enough to cover the monthly interest on your accumulated balance. So you get deeper and deeper in debt. And I think this is a terrible policy that they allow credit card companies to do that, where, okay, you can stay current as long as you pay this minimum payment. And the minimum payment doesn't cover the increase in the interest, the monthly interest charge. So you just go deeper and deeper and deeper in debt. Well, this sort of thing leaves people with no reserves at all. We've had these reports that hardly anybody in the country can raise $400 cash without selling personal possessions. I've written about this. We've probably talked about it in previous shows.
Yes.
Well, if you've got a population and they can't raise $400 cash, they've got no protection against anything going wrong. How would you suppose you were injured, or you are sick, or you're out of work, or you lose your job, or you got a mortgage, you got a car payment, you can't even raise $400. So, yep, being in debt makes this even worse, because we've learned too that unlike during the 30s, the policymakers are not concerned with individuals. Who went busted during the financial bust of 2007, 2008? The individuals, homeowners, not the banks. So, in other words, policy didn't save the homeowner, it saved the bank. And the banks that had made fraudulent mortgages, created derivatives and gambled on them, they all got bailed out. But the guy who lost his home, too bad for you, buddy. Well, in the 30s, it was different. The axe fell on the banks, and they tried to help people stay in their homes. So you can see the policy of the policymakers no longer is focused on helping the population. It's focused on, the banks that are too big to fail. And when you think about it, the New York Federal Reserve Bank, which is the bank that implements the Fed's policy, their directors are all the executives of the big banks in New York. And so that's whose interests they serve. So I think the IMF could have given a much stronger warning. And policymakers should step into this, bust up these banks, restore Glass-Steagall, prevent this concentration. But wherever you look in America, there's massive concentration. The media, 6 firms own 90% of the media.
Yeah.
This is an absurdity. This is against our whole tradition. It's against everything. It's against the Sherman Antitrust Act. We see, look at the concentration in digital information. You got Google. Look at Amazon, the concentration there. I mean, it's endless. We have now monopoly. It's pointless to talk about free markets. You've got monopoly, and you've got banking monopoly. Most of the banking is controlled by a few big banks. So we need reforms really more severe than occurred in the 30s, but we're not going to get them. And so most likely we'll end up with some kind of monstrous collapse, or else they'll just keep this thing going forever by printing money.
Dr. Paul Craig Roberts, thank you for the stark appraisal. Good advice. Just get out of debt. At least you can insulate yourself from these big monopolies, mega banks, evildoers, whatever. Paul Craig Roberts, thank you for joining us today on USAWatchdog.com. This is supposed to be a short interview. It ended up pegging out about 37 minutes or so. Thank you for your time. I appreciate it. I really appreciate it. Very good indicator on what to watch for. Watch the dollar. The dollar crashes, the Fed will have to raise rates, period, the end. So, Paul Craig Roberts, of course, your site is paulcraigroberts.org. You are a prolific writer. You take donations. You don't have any commercials. You have some, your books there that you sell. You also have a donations button. I tell people to go there and support your site. And thank you again for coming on USAWatchdog.com.
Well, Greg, we all appreciate what you do.
Well,
the efforts you make for people, we all appreciate that. And it's important. And thank you very much.
I just try to give smart people, which you're one of them, a platform to talk so we can understand what's going on. And you helped us today. Thank you, Dr. Paul Craig Roberts, for coming on USAWatchdog.com.
So long.